Everyone thinks the story is crypto versus banks. But the real story is what happens to the economy if money starts leaving the banking system. If your deposits move away from your bank, it doesn't just hurt their profits. It fundamentally changes how mortgages, business loans, and even credit cards get created. When deposits leave, the banking system's ability to lend money shrinks. And that raises a much bigger question. What actually happens to the financial system if deposits begin migrating somewhere else? The moment they do, the entire credit system has to adjust, potentially triggering a slow, silent contraction of the credit that fuels our entire economy. You hear the headlines every day: the volatility of Bitcoin, the risks of decentralized finance, and the calls to regulate crypto. And while some of those concerns are valid, they are a convenient distraction. That's the headline story. The deeper story is about the plumbing of the financial world. It's about who controls the flow of money, and more importantly, the creation of credit. The real threat to the banking system isn't a volatile asset like Bitcoin. It's the digital dollar, or stablecoin. And to understand the systemic risk, you first have to understand the fragile secret the entire modern banking industry is built on. It's a concept you've likely heard of, but its true power is rarely spelled out: fractional reserve banking. Think of the old goldsmiths. People deposited gold for safekeeping, and the smith issued a paper receipt. Soon, people started trading the receipts directly because they were more convenient. The clever goldsmiths noticed that only a small fraction of people ever came back for their actual gold at the same time. This gave them an idea. What if they issued more receipts than the gold they held? They could lend these extra receipts out and charge interest, essentially creating credit out of thin air. That was the birth of fractional reserve banking. Today, when you deposit $1,000, your bank can lend out a large portion of it. That loan becomes a deposit in another bank, which then lends out a portion of it, and so on. This is the money multiplier effect. Your initial deposit is used to create a much larger amount of credit in the economy. But this design has a dangerous fragility. The system creates a, quote, duration mismatch. Your checking and savings accounts are short-term liabilities for the bank. You can demand that cash back at any moment. But the bank uses your on-demand money to fund long-term assets, like 30-year mortgages. They are funding illiquid, long-term promises with your liquid, short-term cash. It all works perfectly as long as the deposits don't leave. So, what exactly are these digital dollars or stablecoins? They are crypto tokens designed to hold a stable value, typically pegged 1-to-1 with the US dollar. Unlike Bitcoin, they aren't meant to be a volatile investment. They're designed to be digital cash. The most prominent ones are backed by reserves of actual cash and short-term US government bonds. For every one digital dollar token, there is one real dollar or a highly liquid equivalent held in reserve, often transparently audited. This gives them the stability of the dollar, but with the superpowers of crypto. First, they operate 24/7, 365 on global blockchain networks. You can send millions of dollars across the globe on a Saturday night in seconds, for a fraction of the cost of traditional banking. Second, they are programmable. Developers can build new financial applications directly on them without needing a bank's permission. But here's the part most people miss. This is the feature that represents a code-red threat to the banking model: the potential for yield. Your checking account pays you almost nothing. The bank takes your money, lends it out at a much higher rate, and pockets the difference. What if you could hold your digital dollars on a transparent platform that gives you a direct cut of the yield from the underlying reserve assets? Why would anyone keep more than the bare minimum in a zero-interest bank account if a safe, liquid alternative existed that paid a competitive return? This isn't just competition. It's a direct threat to the cheap funding that banks have taken for granted for a century. But here's where the story becomes dangerous for the financial system. This brings us to the core systemic risk. When you pull your $1,000 out of a bank and put it into a fully reserved stablecoin, you fundamentally change the mechanics of money creation. Your $1,000 in a fractional reserve bank could have supported up to $10,000 in new loans through the money multiplier. But when that $1,000 is moved to a stablecoin backed one-to-one by a Treasury bill, it supports only that $1,000. It can be sent around the world, but it cannot be multiplied. The result is a deleveraging of the system, a credit contraction. For every $1 billion that flows out of deposits and into stablecoins, the banking system's capacity to lend shrinks by a multiple of that. Suddenly, banks have less cheap fuel for their lending engine. So what does this mean for your bank account, your mortgage, and your savings? At first, banks would be forced to raise interest rates on savings accounts to compete, something they haven't had to do in over a decade. This would immediately crush their profit margins. But if the outflow is large enough, they can't just compete. They have to shrink. They would be forced to tighten lending standards, fewer mortgages, fewer loans for small businesses, slower economic growth. This is the systemic crisis that regulators see coming. Not a sudden collapse, but a slow strangulation of the credit that fuels our economy. A credit crunch can feel abstract, so let's make it concrete. Where is the biggest vulnerability in the US banking system right now? Commercial real estate, or CRE. And which banks are most exposed? The regional and community banks. These smaller banks are the lifeblood of local economies, and they are disproportionately on the hook for funding commercial real estate. While CRE loans make up just 6.5% of assets at America's biggest banks, they account for nearly 29% of assets at smaller banks. These regional banks are almost entirely dependent on local customer deposits to fund their operations. Now connect the dots. These are the exact banks that would be hit hardest by a deposit flight to stablecoins, as their low-cost funding is the most fragile. At the same time, the CRE market is already under immense stress from high interest rates and post-pandemic vacancies. These banks are holding long-term loans on office buildings that are falling in value, funded with the on-demand deposits that are now at risk of walking out the door. When those deposits start to drain away, the bank's funding costs spike. More importantly, they lose the ability to refinance those real estate loans when they come due. This is precisely the dynamic that caused the regional banking stress in 2023. A digital dollar exodus would act as a permanent structural accelerant of that same pressure. And as it turns out, we've actually seen this movie before. We just have to rewind to the 1970s. Back then, government rules known as Regulation Q capped the interest rates banks could pay on savings accounts. With inflation soaring, people were losing money by keeping it in the bank. In response, the financial industry created an innovation called the money market fund. These funds allowed average people to pool their money and access the much higher yields of short-term government debt that were previously only available to large institutions. The result was predictable. A torrent of money fled from low-yielding bank accounts to higher-yielding money market funds. Assets in money market funds exploded from just a few billion in the mid-70s to over $185 billion by 1981. Banks were bleeding deposits. They warned of a credit crisis and lobbied Congress. The system didn't collapse, but it triggered a painful, seismic shift. The government was forced to deregulate interest rates, allowing banks to finally compete by offering higher yields themselves. The evolution of financial infrastructure forced the old system to adapt. The parallels to stablecoins are impossible to ignore. History shows that when a better, higher-yielding alternative to bank deposits emerges, money moves. But the deposit story isn't the only disruption happening. Beyond threatening the deposit base, digital dollars attack another core pillar of bank revenue: payments. The current global financial system runs on old, slow rails, like Swift. If you've ever tried to wire money internationally on a Friday evening, you know the process is slow, expensive, and often involves multiple intermediary banks that each take a cut. This system shuts down on weekends and can take days to settle. Banks make hundreds of billions of dollars annually from these payment services. Stablecoins running on global blockchains offer an alternative: instant settlement, 24/7, for a fraction of the cost. This isn't just about making it cheaper to send money to family overseas. It's about re-engineering the plumbing for global commerce, trade settlement, and corporate cash management. This is why, despite the risks to banks, many in Washington see a strategic opportunity. A fully regulated US digital dollar could ride on these new, instantaneous, global blockchain rails, reinforcing the dollar's dominance against competitors like China's digital yuan. The government isn't just a referee here, it's a player with its own strategic interests. This battle for the future of money will directly impact your financial life. This will likely be a slow, multi-year adaptation, not an overnight apocalypse. First, expect your savings account to change. For decades, you've been a captive, low-cost lender to the banking system. The rise of credible, yield-bearing alternatives will finally force banks to compete for your money. This could mean higher interest rates on your savings, but it also presents a new choice. Keep your cash in an insured bank account or move some to these new platforms for a higher return, accepting a different set of risks. Second, expect a shift in credit. If banks lose their monopoly on cheap funding, their capacity to lend will likely shrink. It could become harder and more expensive to get a mortgage or a business loan. The era of easy credit, fueled by artificially cheap deposits, could be ending. Finally, the very idea of a quote, bank account may evolve. It could shift from being the center of your financial world to just one of many apps you use to manage your digital cash. Similar to how email became just one app on your phone instead of the entire purpose of being online. So, the real reason banks fear digital dollars isn't about Bitcoin. It's not even just about competition. It's about the great unbundling of their business model. For a century, banking has bundled three things: the safekeeping of money, the facilitation of payments, and the creation of credit. They could only do this because they had a monopoly on the first two. Digital dollars, for the first time, decouple these services. They offer a potentially better way to hold and move money, stripping banks of their primary advantage: exclusive access to a massive pool of cheap, stable funding. The real story isn't crypto versus banks. The real story is who controls the creation of credit when money itself starts to move in a fundamentally different way. This is one of those shifts that becomes obvious once you see how the financial system actually works.